You are listening to The Vocal Technologist. Spoken tech for your ears.
Okay, so if you're building something ambitious right now, it feels like the whole world of venture capital, all the startup news, it's just this constant stream, almost contradictory sometimes.
Oh, absolutely. One minute you hear about someone raising, $1 billion. Huge valuation.
Right. And the next, an IPO that everyone thought was hot just kind of fizzles out.
Yeah, it's exhausting just keeping track, let alone actually being a founder in the middle of it.
Definitely.
But, when we look across what's been happening recently, the market isn't really chaotic.
Yeah.
It's more divergent, extremely divergent.
Divergent. How so?
Well, the founder game today, it seems defined by these extremes. You've got this elite few pulling in absolutely colossal funding rounds. They're like capital magnets.
Okay.
And then pretty much everyone else is facing this intense strategic pressure. It's driven by, what the public markets demand now, and of course the speed of AI changing everything.
That's the signal we need to pull out, isn't it? We need to get past just the headlines and really understand what's working at both ends of that spectrum.
Exactly.
So our mission today, let's unpack those huge financial moves that are separating the winners, look at the survival strategies needed in this AI era, and maybe touch on the mindset, the psychology that keeps the best CEOs going.
Sounds good. Let's jump straight into the capital part, because we're not talking seed rounds here. We're talking checks so big they kind of reset what scale even means.
Yeah, I look at some of these numbers, and honestly, I wonder if VCs have just decided money's no object for certain things, particularly deep infrastructure. The big rounds are getting so much bigger.
That's definitely the pattern. Look at Grok. They just secured, what, $750 million?
Wow.
Puts their post-money valuation at $6.9 billion. And this cash isn't just, for keeping the lights on. It's specifically targeted at their global infrastructure.
Okay, infrastructure. Let's just pause there for a sec. Our listeners are sharp, but maybe not everyone lives inside a data center day to day. What exactly is that, and why does it command a $750 million check?
Right. Fair point. So simply put, inference is when you take an AI model that's already been trained, like a big language model, and you actually run it. Every time a user asks a question, generate something. That's inference. It's the deployment part.
Got it. So using the AI, not building it.
Exactly. And as AI moves out of the lab and into real business tools, the demand for hardware that can handle that constant output, fast, cheap inference, it's just exploding. Grok is basically betting that running the daily requests is going to be an even bigger deal than training the models in the first place.
Okay, that's a huge bet, super expensive. Is that kind of spending sustainable, or are VCs just like throwing cash at anything with AI inference written on it?
Well, it seems pretty targeted. When investors commit this much, they're looking for really foundational tech, stuff that needs almost like a national level effort. Look at Quantum, even bigger. They raised $1 billion in their Series E, now valued at $7 billion.
The $1 billion.
Yeah, and that capital is specifically for building million-qubit scale, fault-tolerant quantum computers.
Fault-tolerant, that sounds important. Like the quantum computers that might actually work reliably, which is notoriously the hard part.
That's exactly it. They're not funding just a slightly better chip. They're funding a massive generational project, building new computing sites, too, in Brisbane, Chicago.
Wow.
So it shows, the market will pour in insane amounts of money, but usually only when the vision is truly transformative and the tech feels fundamental.
Okay, so the private markets are cheering for these moonshots. But then these companies try to go public, and bam, they hit a totally different kind of wall. The public market is way less forgiving.
Absolutely. It's like the ultimate editor. The IPO market forces accountability. We saw that with StubHub, right? They went out on the NYSE, raised a good chunk. $800 million is serious money, but the stock immediately dropped, fell 6%, closed below its pricing.
Yeah, $22 after pricing at $23.50. Why? They had decent revenue, didn't they?
They did. $828 million in revenue first half of 2023. But, and this is the key thing, now they still lost $76 million.
Ah, the bottom line.
Exactly. Public investors are basically saying, look, big revenue is nice, but we need to see a clear, quick path to actual profit. That discipline is way tighter than it was back in, say, 2021.
Maybe it's a return to sanity. Because StubHub stumbled, but the IPO window isn't shut, right? The market's actually quite busy again, this great IPO awakening people are talking about.
It is busy, yeah, but it's a disciplined busy. We saw 6 companies raise, what, $4.4 billion combined in just 5 days recently?
Oh, busiest since 2021.
Right. But the big difference now is the focus on conservative pricing and actual profitability. Look at Klarna.
Right.
They priced way, way below their peak $46 billion valuation from the bubble. Super conservative. But the market liked it. The stock popped 15% on day one.
Klarna is a really interesting story, especially if you look at how Sequoia, one of their big investors, played it.
Yes. This is such a critical lesson for you if you're a founder listening. Sequoia made out like bandits at 7x return. How?
How?
By not jumping into those crazy inflated funding rounds back in 2021, they resisted the peak hype.
So they valued a good return later over the highest possible valuation number right now. Stability over the vanity metric.
Precisely. And because they did that, they could hold firm even when Klarna went through that massive boardroom fight, that huge 85% down round. Their cost basis wasn't nuts.
Right.
The lesson is clear. Sometimes avoiding the absolute peak valuation makes your company stronger, more resilient in the long run. Anti-fragile even.
That resilience. That's the perfect transition, because once you have the money, whether it's a careful $7 million or a massive $1 billion, you still have to execute. You have to survive, especially with AI threatening to rewrite the rules for everyone.
Yeah, the whole SaaS world, software as a service, is being fundamentally redefined. It feels like we're entering an eat or be eaten phase, meaning AI disruption forces established software players to innovate fast or risk becoming irrelevant. And the big guys know it. They're looking to acquire. So smaller SaaS startups, they need to lock down big enterprise deals quickly to get established, or they just become someone else's feature.
Okay, so if your product is constantly shifting under your feet because of new AI capabilities, how do you even price it? How do you keep control of your finances?
That's the million-dollar question, or maybe $1 billion now. You have to look at companies that mastered the last era and see how they're adapting. Snowflake's a great example.
Right. Usage-based pricing. They kind of defined that.
They did. But now, their big challenge is making that usage model predictable in the age of AI. What happens if your users suddenly start using 10 times the compute power because of some new AI feature? Your finance team needs visibility into that before the giant bill arrives.
So it's not just about the product anymore. It's the whole company needing to be aligned.
Totally. Finance, product, go-to-market, engineering, everyone has to work together for predictability, visibility, control over pricing. Usage-based is great until your costs suddenly go wild. Precision matters more than ever.
Let's talk execution then, because we've got a couple of great examples of companies finding breakout growth, but in pretty different ways, both driven by intense focus, though. Let's start with the structured approach, Replit.
Yeah, Replit really showed how structure can turn community buzz into serious revenue. They grew incredibly fast from like $2.8 million ARR to $150 million.
Whoa.
And that wasn't just luck or going viral randomly. It was super disciplined, structured growth. They would cohesive product launches. They focused on optimizing how users move through their life cycle. And critically, they channeled all that community energy into structured campaigns.
I remember seeing how they connected their Replit agent, the coding helper, directly to specific content pushes. That link between product, content, activation, that seems key.
Absolutely. They basically weaponized discipline. And then you have Bolt, which looks like the total opposite the overnight success.
Right, Bolt, the one-prompt app builder. $0 to $40 million ARR in 6 months. With only 15 engineers. That just screams instant product market fit.
It looks like it on the surface. But here's the crucial backstory, the part that shows the patience needed for deep tech. That incredible 6-month run, it was built on 7 years of hard infrastructure work.
7 years. Doing what?
For 7 years, they were laser-focused on building something called Web Container. It's this really sophisticated tech that lets you run Node.js environments entirely inside a web browser.
Okay, so they were building the plumbing, essentially, before anyone knew they needed that kind of house.
You got it. They built the enabling technology, basically waiting for the other piece, the large language models, to get good enough, which happened in 2024, to actually generate full acts based on a prompt.
Oh.
So the success wasn't overnight at all. It was a pivot, yes, but one that was only possible because of those 7 years building the deep foundation. The lesson. The strength of your underlying tech determines how fast and how well you can pivot later.
That ability to grind for 7 years, staying focused, that leads us right into the internal game, doesn't it? Building these kinds of companies, the ones needing huge capital or facing down AI threats, it's just a psychological marathon. This is where maybe touching on my world as a vocal technologist, understanding the founder's internal operating system is so vital.
Oh, that internal resilience is everything. Ben Horowitz talks about this, right?
Yeah.
The CEO's job is about running toward fear.
Right.
His point is, successful founders aren't defined by one big heroic move. They're defined by making lots of small, tough decisions. Decisively, every single day.
It's the constant pressure, the accumulation of those hard calls.
Exactly. And one key piece of his advice, prioritize finding great people over trying to fix or save underperformers. That's a really hard, painful decision sometimes.
Yeah.
But avoiding it, that leads to death by 1,000 cuts.
Yeah.
The job demands continuous, decisive action, even when it's uncomfortable.
Decisiveness is key. But founders also need to be efficient, right? Especially raising money. We need to cut through the endless dance between VCs and founders. What's like the #1 practical tip for you, the listener, when you're in that pitch meeting?
Okay, you need to force clarity. At the very end of that first meeting, ask the VC point blank, what are the odds you would invest?
Ooh, that sounds direct. Maybe uncomfortable.
It is. It forces the kind of reality check you probably wouldn't get until week 6 of follow-ups.
Right? Why that specific question? What are the odds? Why not just, are you going to invest?
Because it's more nuanced. An experienced VC, they usually have a pretty good gut feeling by the end of meeting 1, is this a 20% chance, an 80% chance, maybe 0%.
Okay.
Asking for the odds gets you past the polite maybes and avoids months of being ghosted. It makes them give you real insight into their conviction level right then and there.
That's brilliant. Saves so much time and angst. Okay, let's wrap with maybe the most fundamental psychological idea here, something that goes beyond pitching or product, this idea of identity versus goals.
Yeah, this is, it's incredibly powerful. We tend to focus on goals, right? My goal is to ship code every day. My goal is to raise our Series A. But goals are actually less powerful drivers than identity. When you define who you are, like, I am the type of person who ships code daily, the behavior just follows. It becomes non-negotiable because it's about reinforcing who you are.
So how does a founder use that? How do you weaponize identity in this crazy competitive landscape we've been talking about?
You apply it at the highest level. Instead of just having a goal like, we need to hit X revenue, you work to become the type of CEO who builds inevitable companies.
Inevitable companies. I like that.
Once you truly embody that identity, that resilience, that focus, that belief in market leadership, then all the tough actions, like finding product market fit or raising that huge round or navigating an 85% down round, they become necessary steps. The identity pulls the behavior along with it.
That framing really ties it all together, from the mega funding to the 7-year grind to the pivot. The whole founder journey today really is defined by these high stakes, these extremes.
It really is. The market is basically demanding that you build one of these inevitable companies, robust enough for huge investment, strong enough for public market scrutiny and the demand for profit, and agile enough to pivot hard based on real foundational tech, not just clever marketing.
And you see that reflected in the valuations, right? The top 1% of AI startups are getting multiples 3x, 10x what you'd normally see. The capital is really concentrating on that perceived inevitability.
It is. But here's maybe the final thought for you to chew on, something about the long-term view. While the companies building the core AI models might be worth hundreds of billions today, historical parallels suggest generative AI isn't just a product. It's more like an infrastructure revolution. Think shipping containerization back in 1956.
Containerization, okay. That changed everything about global trade, made it way cheaper, way more efficient. But the folks who invented the first steel box didn't capture all the trillions in value created, did they?
Yeah. Exactly. Containerization unlocked trillions globally. And AI, projections are it could generate somewhere between $1 and $7 trillion in value across the economy. But here's the kicker. History suggests most of that value, the vast majority, will eventually flow to consumers through cheaper, better, faster services built on top of the AI infrastructure.
Yeah.
It won't all stick with the original investors or the builders of the core tech. So the critical question for you as you build is, where are you positioning your inevitable company to capture a meaningful slice of that massive economic value shift? That's the real long game.
Spoken Tech, for your ears.